trade.
So here's a question. What separates losers from the winners? And it sounds like a question which is full of fluff, but just think beneath the surface. The answer is simple and has a lot to do with discipline. And as we talk about trading discipline, the first thing that we have to understand is risk. And it's a word that we use a lot, but technically speaking, what does it mean and what does it do to our profits? And there you can see, risk is basically the amount that one stands to lose in a trade, and it can be measured in many ways, through a range or through volatility. Volatility, of course, is standard deviation, and we won't get as far as that, because I'm sure a lot of traders, of course, know that and use that, but just the basic range is good enough, as in if you're trading on the Nifty, if you're trading intraday, if you know the range every day, what's the high and the low of the day, that's the range, and what is that as a percentage of the Nifty, that's the percentage value that you're standing to lose in a day. That's what we mean by risk. So how much are you willing to risk? How much can you afford to risk? Those are important things to look at. Dr. Narayan, if you're looking at a trade, say for a 1 week, 1 month, or maybe 1 year horizon, how does risk stack up there? What percentage numbers should we look at, or how do you actually just deal with risk?
See, it's a little bit mathematical, but we'll try to keep it very, very simple. The first thing to look at is what is the range that let's say the Nifty shows in a matter of a week, a month, or a year. Now in a week, if you were to go back and examine the data, you will find the daily average fluctuation of the Nifty is about 1.7%, the weekly average is about 3.5%, and the monthly average is about 11.5%. So this is the volatility range that you are really looking at. What this means is that the Nifty can actually fluctuate about 100 points, 80 to 100 points in a given day. So if you are looking at a stop loss on even a single contract of your Nifty, if you split this into a 50-point range or a 100-point range for a day, on a 50 shares of Nifty, you are looking at a minimum risk of about 2,500 rupees or a maximum risk of about 5,000 rupees. So your trading equity must be at least capitalized for that much amount of money. Not just for one trade, but for a series of trades. You should assume about 20 trades. Right? If you are assuming about 20 trades and you are looking at a 5,000 or 2,500 rupee kind of loss, then the minimum per trade, then the minimum trading equity that one should have to trade one lot of Nifty should be anywhere ranging from let's say 50,000 rupees to a lakh of rupees. If it is short of that, even the normal volatility of the market can blow you out of the game, and that's what you must try to stay in. You must take in the game and you must plan it in such a manner that the risks that you take are not so large that you will be taken out of the game. So this is the sort of small mathematics for one lot of Nifty using just the daily fluctuation. The wider you go out in time, let's say you take a weekly time frame, then you're talking about 3.5%. And when you're talking about 3% plus, then you're really talking about 150 to maybe, let's say 160, 180 points. Which means that your trading equity has to increase thereby. So the longer the time frame that you are talking about holding your trade, the larger has to be the size of your equity, because the movements across that period will be larger, and you must be able to take the normal volatility of the Nifty. Your trading equity must meet that. Without that, you will be out of the game.
So I think it's fair to say that look at the amount that your own stock can vary up or down in the time horizon of your trade, and your own risk tolerance should be higher than that.
Otherwise you will be out of the game.
Because you lose essentially your entire trading capital.
Yeah, the normal volatility of the market will actually trigger your stops, which is not the way it should be.
Right.
You have to provide for it.
Right. And stop loss is something that we will of course talk about. That's the limit at which you need to cut your losses. Well, it's easy to read about trading discipline and remember it, but conveniently we forget it at the time of action. It's a bit like reading a book on weight loss and diet control, and you forget all of it when that packet of chips is right there in front of you. So the next question, of course, is to do with what investors tend to do, which is out of line with trading discipline. Dr. Narayan, where is it that investors tend to slip?
See, if you break it right down, what is trading all about? Trading is all about execution, right? And so therefore you must get your execution right. Sounds much simpler when I say it, but execution is dependent upon getting the right signals. And getting the right signals is dependent upon getting your set of methods right. So what you really need to do to reduce risk and to bring in trading discipline is to A, have a method, B has the signals, doing a sufficient amount of back test, C develop a faith in them, and D be able to execute them. Having a method and being able to execute it are two different things, right? So you may have a method, but you must develop the mindset which will enable you to execute that method in as flawless a way as possible.
Right.
That is trading psychology and that is trading discipline.
Well, we've promised to be completely hands-on in the show. We would love to apply the concepts that we learn as we go along, and so here's a chart quiz for you. We'd like you to send in your analysis of the Nifty and the Infosys charts. So take a look at those charts and tell us what you expect will happen in the next 1 to 2 weeks based on your analysis, and email that to us at talkingtechnicals@etnow.tv and possible trade recommendations based on your chart readings. And we'll come back next week and tell you what actually happened and whether you did miss out on extra profits because you closed your position too early, or did you take too much risk, or were you in fact a very smart trader. We'll let Dr. Narayan decide that for you. Time to unwind, and when we come back, more insights into the trading world, what some of the smartest traders on the street love to do. Does it work or does it not? A total out of the box experience.